In the last 2 years, the monetary policy has done the heavy lifting by keeping surplus liquidity in the system and low interest rate to support the growth. But now with retail inflation crossing the 6% mark, the RBI's hands are tied. RBI will now have to signal the exit of the surplus liquidity policy to check the inflationary pressure. Inflation is like a tax on the poor. The COVID has already widened the income inequality gaps as it has pushed millions of people below the poverty line. Both monetary policy and the fiscal policy have to work in tandem to keep a check on inflation and also at the same time support economic recovery hit by the COVID second wave. Is there still scope left in the monetary policy to support the economy? Should RBI take inflation threat more seriously and start signaling the exit from the easy monetary policy? What more can be done on the fiscal side as the union budget for 21-22 has clearly laid down the fiscal measures? Finally, if at all there is a need for stimulus, what should be the shape and size of such a package? Let's tackle each of these issues in this video. So far, the RBI has been dismissing the inflationary pressure as a supply side issue and not demand led because of COVID and local lockdowns. But the retail inflation or the CPI has crossed the 6% mark in the month of May, which is the upper band set by the government for the Monetary Policy Committee. RBI's inflation projection of 5.1% for the entire year looks very challenging given the rise in the commodity prices, oil and food. The rupee depreciation against US dollar has also increased the threat of imported inflation. It is time now that the RBI has to take the inflation threat very seriously and give a guidance to the market. Last week, US central banker for the first time has hinted interest rate hikes in 2023, which is 18 months from now, as the inflation is rising and growth is coming back. While the RBI will continue to support the government borrowing program, which would lead to its balance sheet size expansion, the monetary policy window to support the economy, which is on a recovery path, is very limited. Before getting into the stimulus or more fiscal measures, let's look at how the budget 21-22 is progressing. GST collection was the highest for the month of April at Rs 1.40 lakh crore. The collection for May, which was impacted by COVID second wave, has been quite encouraging at Rs 1 lakh crore. If the GST collection run rate is over Rs 1 lakh crore per month, the yearly collection will easily cross the Rs 12 lakh crore figure of the last 2 years. The advanced collection of corporation tax and personal income tax has grown by 146% in the first quarter, which is also very encouraging. Budget has estimated direct tax collection at Rs 11 lakh crore, which is 17% higher than the first pandemic year of 2021. The RBI has also paid a dividend of Rs 1 lakh crore to the government. If the government can manage the PSU disinvestment well in the current booming stock market, the revenue side looks sorted for the year. On the expenditure side, the government should move fast in areas like infrastructure and roads that the government has decided in the budget. The development financial institution model suggested in the budget should be scaled up fast. The policy hurdle or the concerns of the private sector, especially in the infra side, should be addressed for better utilization of limited funds. Now the big question comes, is there a need for additional stimulus? And if yes, what should be the shape and size of such a package? Clearly, there are fiscal roadblocks. The government has set a new 5-year fiscal consolidation path to 4.5% fiscal deficit by 25-26. The fiscal deficit of 9.3% in 2021 and the projected 6.8% in 21-22 has already crossed the level of the global financial crisis. The public debt to GDP, which includes both central and state government debt, is 90% of the GDP. The current fiscal policy mandate is to expand, borrow, spend and grow. The assumption is that if the growth comes back, even with higher debt and fiscal deficit, the higher GDP will push up the revenues and also neutralize higher fiscal deficit and government borrowing because of the denominator effect. There is a big if, as the second COVID wave has already upset the budget calculation. The additional fiscal stimulus, if any, has to be directed at a couple of critical areas. First, the vaccination for all. The government should do whatever it takes to vaccinate all and also faster. The first two COVID waves have already exhausted all the firepower of RBI and the government. A third or the fourth wave will be devastating for the economy. There is a big demand to increase the direct income support for the poor. There are ways to reduce the burden. The excise duties, cess, and the other taxes imposed by center and states on oil, for example, should be in a more rational and coordinated manner. Some increase in Menegra expenditure from the current level of Rs 73,000 crore for 21-22 is justified. The government guarantee to bank is another area where the banking system could be used to provide funds for MSME and other sectors worst affected by the lockdowns. Clearly, the burden of supporting the economic recovery is gradually falling on the fiscal policy, as the monetary policy conditions globally are taking a reversal, and it is time to think out of the box to use the fiscal tools.